Hey everyone, welcome back to Corporate Decoder, the place where we crack open massive financial documents so you don't have to. This quarter we are diving into PIMCO Asset-Based Lending Company, LLC's latest 10Q report, and let me tell you there are some juicy financial tables in here that tell quite the story. If you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we break down more filings and discuss market trends. So what did PIMCO Asset-Based Lending Company LLC get up to in the quarter ending the 30th of September 2025? Well, they are telling us they are essentially a lending platform focused on asset-backed instruments, which means loans and other financings backed by things like real assets or financial assets. They are aiming to build a diverse portfolio of these deals outside of typical corporate and real estate lending. Think consumer loans like student loans or auto loans, and also non-consumer loans like trade financing or even specialty lender acquisitions. They want to buy income-producing assets where they see low risk of capital loss or attractive returns, even in tough times. Let's jump straight into the numbers to see how this strategy played out in the last quarter. It looks like for the 3 months ending the 30th of September 2025, their total investment income was about $2.8 million. This comes from interest income and dividend income from affiliates. Now, expenses were higher than income for this specific quarter. Total expenses were around $3 million. However, they did have a significant amount of expense support waiver and rebate totaling nearly $2.5 million. This means the operating manager PIMCO stepped in to cover a good chunk of those costs. After all that, their net expenses for the quarter were only about $554,000. This left them with a net investment income of about $2.2 million for the period. Interestingly, they also saw a net change in unrealized appreciation totaling over $780,000. This means the value of their investments grew during the quarter. All in all, this led to a net increase in net assets resulting from operations of almost $3 million for the quarter. Looking at their balance sheet as of the 30th of September 2025, the company had total assets of roughly $333 million. Their investments at fair value make up the bulk of this with over $177 million. They also have significant investments in affiliates worth over $87 million. On the liability side, they have about $103 million in total liabilities. When we look at net asset value per S-share for different share classes, things get interesting. For example, the Anchor shares in Series 2 had a net asset value of $10.17 per S-share. The E-shares in Series 2 had $10.19 per S-share. These numbers show the underlying value of each investor's stake in the company. Now, about how they value these assets, they use a 3-level fair value hierarchy. Level 1 uses quoted prices in active markets. Level 2 uses other observable inputs, and Level 3 uses significant unobservable inputs, which means they have to make more educated guesses. For Series I, almost all their investments at fair value fell into Level 3, which means they are using a lot of their own assumptions to figure out what things are worth, because there are no easy market prices. For Series 2, a good chunk also falls into Level 3, especially their consumer loans. Let's look more closely at their investments on the 30th of September 2025. For Series I, their total investments were about $1.5 million. For Series 2, it was much larger, over $175 million. Their asset-backed securities were a small part of this Series I had only $20,000, and Series 2 had about $2.2 million. Consumer loans were a more significant portion. Series I had about $210,000 in personal loans, for example, and Series 2 had over $24 million in personal loans. They also hold common stock and preferred stock investments, but these are generally a smaller percentage. A big chunk of their assets, especially for Series 2, are in short-term investments, which totaled over $144 million. This includes repurchase agreements, which are basically short-term loans backed by collateral. They had over $142 million in repurchase agreements for Series I alone. Now, beyond their direct investments, they also have substantial investments in affiliates. For Series 2, these investments were worth over $87 million. This includes outfits like Cavendish LLC, which deals with auto loans, and PIMCO Private Mortgage Opportunities Fund Onshore LP, which, as the name suggests, is tied to mortgage opportunities. When we look at the changes in their Level 3 assets from when they started on the 11th of March 2025 to the 30th of September 2025, we see growth. For Series I, their Level 3 assets started at $0 and ended up at $272,000. For Series 2, they showed a much larger increase, going from $0 to over $31 million. Most of this growth comes from purchases of assets like consumer loans and asset-backed securities. The key driver here for many of these Level 3 assets is the valuation technique used, which is often discounted cash flow. This means they are projecting future earnings and then discounting them back to today's value. For things like common stock, the valuation technique is often based on recent transaction price. They also deal with derivative liabilities, which are essentially contracts whose value is derived from an underlying asset. As of the 30th of September 2025, Series 2 had a derivative liability of about $15,000. These are primarily overnight index swaps, which are used to manage interest rate risk. Looking at events after the 30th of September 2025, they had a pretty active October. They sold unregistered shares to investors raising considerable funds. For Series I, they raised over $1.1 million in one transaction for Anchor shares and another over $9.4 million for Anchor 2 shares. For Series 2, they raised even more with over $15 million from Anchor shares and over $24 million from Anchor 20 shares. This shows continued investor interest and capital inflow into the company. Now let's see what PIMCO itself has to say about all this. They are pretty upfront about the risks involved. They mention things like changes in political, economic, or industry conditions, the interest rate environment, and increasing competition. They also highlight their dependence on the general economy and the ability of their portfolio companies to achieve their objectives. When they talk about their results of operations, they emphasize that their investment income is driven by the deployment of capital and the invested balance of their assets. They mention their asset-backed instruments were 100% fixed-rate investments as of the 30th of September 2025. This usually means their interest income is predictable, but they would not benefit from rising interest rates. Their expenses are quite detailed on page 25. It includes management fees, performance fees, general administrative expenses, and other operating costs. For the quarter ended the 30th of September 2025 series, I had net expenses of just $3,000 thanks to substantial expense support from PIMCO. Series 2 had net expenses of $551,000. This expense support is a crucial element helping to keep their operational costs low. So what does this all mean for the company's direction and its financial health? PIMCO Asset-Based Lending Company LLC seems to be in a growth phase. They are actively deploying capital into asset-backed instruments and seeing increased investor interest as evidenced by the share issuances. The significant expense support from PIMCO is a strategic move to allow the company to focus on building its portfolio without immediate profitability pressure from high operating costs. However, their reliance on level 3 assets for valuation, especially for series, I suggest a higher degree of estimation and judgment is involved in determining reported asset values. This can introduce more volatility and uncertainty compared to assets with observable market prices. A key risk they highlight is their dependence on the general economy and the performance of their investment targets. If the economy falters or their portfolio companies struggle, it could directly impact their returns. Overall, PIMCO Asset-Based Lending Company LLC is building an interesting portfolio in a niche lending market. The strategy of focusing on asset-backed instruments outside traditional lending is potentially lucrative, but comes with inherent risks tied to market conditions and the execution of their investment strategy. Alright, that wraps up our look at PIMCO Asset-Based Lending Company LLC's latest filing. What do you think about their strategy and the reliance on level 3 assets? Let us know your thoughts in the comments below. If this analysis was helpful, please give it a thumbs up and subscribe for more deep dives into company filings. And remember, join our Discord community linked in the description for more exclusive content and discussions. Thanks for watching. See you next time.